Every trader has been there. You open your chart. You pick a time frame, maybe the 15-minute, maybe the 1 hour, maybe the daily. You do your analysis. You find what looks like a perfect setup. You enter the trade. And then one of two things happens. Either the trade immediately moves against you, aggressively, as though the market saw your entry and decided to go the other direction, or the trade moves in your direction for a while, then reverses before hitting your target, stopping you out at break-even or a small loss on what felt like a correct call. Both outcomes feel random. Both outcomes feel unfair. And after experiencing them enough times, most traders conclude that their strategy is broken, their analysis is wrong, or the market is simply impossible to trade consistently. But the strategy is not broken. The analysis is often correct. The problem is something far more specific and far more fixable. The problem is that most traders are using one time frame to do a job that requires two. This article is going to introduce you to the solution that professional traders have been using for decades. A two-time frame system so logical, so elegant, and so effective that once you understand it, you will wonder how you ever traded without it. The 4-hour chart finds the zone. The 1-hour chart pulls the trigger. Let's break down exactly what this means, why it works, and how to implement it with surgical precision. Why single time frame trading fails. Before we go into the solution, we need to understand the problem deeply, because understanding why single time frame trading fails is what makes the two time frame solution make complete sense. The information problem. Every time frame tells you something different about the market. The higher the time frame, the more structural and meaningful the information. The lower the time frame, the more precise and granular the information, but also the noisier. When you trade on a single time frame, you are trying to extract both types of information from the same source. You want the structural context. Where is the market going? And you want the precision. Exactly where do I enter? From the same chart. This is like trying to read both a city map and a street-level navigation guide from the same document. The scales are incompatible. What serves one purpose poorly serves the other. The false precision problem. When a trader uses only the 1-hour chart, they identify a support level on that chart and enter near it. The level looks significant on the 1 hour. But when you zoom out to the 4-hour chart, that support level is actually in the middle of a range between two much more significant structural levels. It has no meaning to the larger players who are trading the 4-hour structure. The result: price respects the 1-hour level briefly, then continues lower to the actual 4-hour support. The trader is stopped out. The level was real on their time frame, but insignificant on the time frame that actually drives market direction. The false context problem. Conversely, when a trader uses only the 4-hour chart, they identify a zone and enter at it. But the 4-hour candle that formed the signal closed 12 hours ago. On the 1-hour chart, price has already bounced from the zone and is now extended, the entry they are taking at the 4-hour level is actually happening near a 1-hour resistance level, with a poor risk-reward ratio and no precise signal to confirm timing. They are entering in the right area, but at the wrong moment. Both of these problems, false precision and false context, are solved entirely by combining the 4-hour and 1-hour time frames. The system, how it works. The logic of the system is simple enough to state in 2 sentences. The 4-hour chart defines the dominant trend direction and identifies the key zones where significant buying or selling is expected to occur. The 1-hour chart monitors those zones and identifies the specific, precise moment when price action confirms that the anticipated move is beginning. 4 hours gives you the map. 1 hour gives you the turn-by-turn directions. Used together, they produce a level of analytical precision that neither can provide alone. Part 1. The 4-hour chart, finding the zone. The 4-hour chart is your strategic command center. Everything begins here. Step 1. Define the dominant trend. Open your 4-hour chart and remove every indicator. Look only at price. Ask one question. What is price doing? If price is making a consistent series of higher highs and higher lows, you are in an uptrend. Your bias for all trades is long. You will only look for buying opportunities. If price is making a consistent series of lower highs and lower lows, you are in a downtrend. Your bias is short. You will only look for selling opportunities. If price is oscillating between two relatively equal levels without sustained directional movement, you are in a range. The system still works in ranges, but your entries will be at the extremes of the range rather than in the direction of a trend. This trend definition on the 4-hour chart is non-negotiable. It governs every trade you take. No matter what the 1-hour chart shows you, you will not take a trade that opposes the 4-hour trend. This single filter eliminates the majority of losing trades that most traders experience. Step 2. Identify the key zones. With the trend defined, the next task is identifying where the market is likely to make its next significant move. In an uptrend, you are looking for pullback zones, areas where price is likely to retrace temporarily before resuming the uptrend. These zones exist at previous swing highs that have now become support. When price breaks above a previous high and then pulls back to that level, the former resistance becomes new support. This is one of the most reliable levels in all of technical analysis, moving average support. The 50-period EMA and the 200-period SMA on the 4-hour chart act as dynamic support in uptrends and dynamic resistance in downtrends. Price consistently returns to these levels during pullbacks before resuming the primary trend direction. Fibonacci retracement levels, the 50% and 61.8% retracement of the most recent impulse move, are the levels where pullbacks most frequently find support before the trend continues. In a downtrend, the same concepts apply in reverse. You are looking for rally zones where price is likely to find resistance before continuing lower. Step 3. Define the zone boundaries. A zone is not a single price level. It is an area, typically spanning 20 to 50 pips on most major pairs, or a percentage equivalent on other assets. Define the upper and lower boundaries of each key zone. Price entering this area is your signal to switch attention to the 1-hour chart and begin watching for the trigger. Part 2. The 1-hour chart. Pulling the trigger. The 4-hour chart has done its job. You have your trend direction. You have your key zones. You know exactly where price needs to reach before you begin looking for an entry. Now you wait. This is perhaps the most important and most undervalued step in the entire system. You do not enter the moment price reaches the zone. You wait. You watch. You allow the 1-hour chart to show you the precise moment when buyers, in an uptrend, or sellers, in a downtrend, are actually defending the zone. What you are waiting for. The 1-hour confirmation signal. When price enters your 4-hour zone, switch your primary attention to the 1-hour chart. You are now watching for specific price action signals that confirm the zone is being respected. Signal type 1, the reversal candle. The most common and most reliable trigger signal is a strong reversal candle forming on the 1-hour chart at the zone level. In a buying zone, you are looking for a hammer candle, small body at the top, long lower wick, showing aggressive rejection of lower prices. 8. A bullish engulfing candle, a bearish candle, followed by a larger bullish candle that completely engulfs it. A bullish pin, bar, very small body, with a long lower wick, showing that sellers initially pushed price lower, but buyers overwhelmed them by the close candle. In a selling zone, the same patterns apply in reverse. Shooting stars, bearish engulfing candles, and bearish pin bars. The critical requirement, the reversal candle must close before you enter. You do not enter in anticipation of the candle closing bullish. You wait for the close. This eliminates an enormous number of false signals. Signal type 2, the break of structure. Sometimes price will enter a zone and begin making higher lows on the 1-hour chart before producing a reversal candle. This process, where price makes a lower low into the zone, then creates a higher low, then breaks above the most recent lower high, is called a break of structure, and it is an extremely powerful confirmation signal. When you see a break of structure forming on the 1-hour chart within your 4-hour zone, it tells you that buying or selling pressure is building. The 1-hour structure is shifting in the direction of the 4-hour trend. This is confluence at its most precise. Signal type 3, the volume confirmation. Whenever possible, and this is particularly relevant for stocks and futures traders. Confirm your 1-hour entry signal with volume. A reversal candle forming on above-average volume tells you that institutional participants are actively involved in the defense of this zone. This dramatically increases the probability that the signal is genuine rather than a random price fluctuation. A reversal candle on below-average volume should be treated with more caution. It may still work, but the institutional backing is less evident. Part 3. Executing the trade. You have the 4-hour trend direction. You have the 4-hour zone. Price has entered the zone. The 1-hour chart has produced a confirmation signal. Now you execute. Entry enter on the close of the confirmation candle, or on a small pullback immediately following it. Do not wait for more confirmation. You already have 3 layers of evidence: 4-hour trend, 4-hour zone, and 1-hour signal. Additional waiting only reduces your risk-reward ratio. Stop loss. Place your stop loss below the confirmation candle's low for long trades, or above the confirmation candle's high for short trades. Why this specific placement? Because if price trades beyond the extremity of the confirmation candle, the signal has been invalidated. The buyers you expected to defend the zone have been overwhelmed. The 1-hour structure that formed your entry signal has been broken. There is no longer a logical reason to be in the trade. Your stop loss should be placed just beyond this invalidation point, not tight enough to be triggered by normal spread fluctuation, but not so wide that it exposes excessive risk. Position size. Calculate your position size based on the distance from your entry to your stop loss, such that the dollar or pip value of that distance equals exactly 1-2% of your account. This is non-negotiable. You may have perfect 4-hour context, perfect 1-hour timing, and still lose the trade, because every trade has the possibility of failure. The 1-2% risk rule ensures that any individual loss is controlled and survivable. Take profit. Set your take profit at the next significant structural level in the direction of your trade on the 4-hour chart. In an uptrend, this is typically the previous swing high or the next major resistance level. In a downtrend, it is the previous swing low or the next major support level. Do not set your take profit based on a fixed pip target or a specific risk-reward ratio into an isolation. Anchor it to the market's own structure, to the level where opposing forces are most likely to embrace meaningful resistance to your trade's continuation. The minimum acceptable risk-reward ratio for this system is 2-1. If the distance from your entry to the nearest significant structure on the 4-hour chart does not provide at least twice the potential profit relative to your risk, the trade does not qualify. Wait for a better setup. Part 4. Managing the trade. Once you are in a position with your stop and target set, trade management is minimal. Check the 4-hour chart once per 4-hour candle close. Ask 2 questions. Has the 4-hour trend structure changed? Is price still behaving in a way consistent with the thesis that triggered your entry? If yes to both, do nothing. The trade is running as intended. If the 4-hour trend structure breaks, the market makes a lower low in an uptrend or a higher high in a downtrend, on a 4-hour closing basis, the foundation of your trade's thesis has changed. Consider reducing your position or exiting entirely, even if price has not reached your stop loss. The trailing stop, advanced management. Once price has moved in your favor by an amount equal to your initial risk, consider moving your stop loss to break even. This protects your capital from a losing trade while keeping you in position to capture the full potential of the move. If price continues strongly in your direction and creates a new 4-hour swing structure in your favor, you can trail your stop to below the most recent 4-hour high or low. This allows you to participate in extended trend moves while protecting accumulated profit. Real-world application, step by step. Let's walk through a complete trade from start to finish. It is Sunday evening. You open your 4-hour chart on Euro USD. Price has been making consistent higher highs and higher lows for the past 3 weeks. The trend is clearly up. You identify a key zone. The previous 4-hour swing high at 1.0851, 0.8882 has been broken, and this level is now expected to act as support if price pulls back to it. You also note that the 50-period EMA on the 4-hour chart, is rising and sits at approximately 10860 within the zone. Confluence. Monday morning, price begins pulling back from the recent high. By Monday afternoon, price enters your zone, trading between 1.0850 and 1.0880. You switch to the 1-hour chart. Over the next several hours, you watch price action on the 1-hour chart within the zone. Tuesday morning, price dips briefly to 10848, then recovers. Bullish hammer candle closes on the 1-hour chart. The close is at 1.40868 within the zone. This is your trigger. You enter long at 10870 with a stop loss at 10835, below the hammer's low and below the zone's lower boundary. Your risk is 35 pips. Your target is the previous 4-hour swing high at 10970. Potential profit, 100 pips. Risk-reward ratio, approximately 2.85:1. You set your orders and step away. The 4-hour trend is up. The zone has held. The 1-hour has confirmed. The system has done its job. Conclusion. 2 time frames, 1 complete system. The 4H and 1H combination is not a complex strategy. It does not require advanced mathematics, proprietary indicators, or years of screen time to master. What it requires is understanding, a clear understanding of why each time frame is performing its specific function in the system, and the discipline to wait for both functions to be fulfilled before entering. The 4-hour chart finds the zone, the structural area where the trend is most likely to resume, and where the highest probability trade setups exist. The 1-hour chart pulls the trigger, the precise, timed entry signal that confirms the zone is being respected and that the anticipated move is beginning. Together, they give you something that no single time frame can provide, both the context to know where to be and the precision to know exactly when to be there. This is how professional traders think. This is how they define their trades, time their entries, and consistently extract profit from markets that destroy the majority of retail participants. Now it is your system too. Drop a comment. Are you currently using multiple time frames? What combination works best for you? The trend is your friend until the bend at the end. Ed Seykota.